Good morning, everyone, and welcome to the next edition of Prudential's series of fund-specific webinars, where today we're going to discuss the Prudential Balanced Fund. The Balanced Fund is one of our largest unit trust funds, and we, as Prudential, also manage a significant portion of assets in life-wrapped and segregated mandates for clients that are run to materially the same model. This is the third of these seminars. In the first two, where we for both had more than 500 viewers, we covered the Prudential Inflation Plus Fund, firstly, and that specific session took some time to discuss the listed property sector and inflation-linked bonds. And then the second webinar dealt with our income funds and specifically looked at the South African bond market. In today's session, we're going to focus a bit more on asset allocation decisions, as well as the equity market, domestic and global, which make up a large portion of the balanced fund. With me today to assist me in the session, I have Michael Moyle, who heads up the Prudential Asset Allocation team, and Chris Wood, who's one of the senior equity portfolio managers that are responsible for the management of the equities within the Prudential Balanced Fund. Thank you to all of those of you who sent through questions beforehand. We have prepared a few slides that we will be showing and referencing behind the camera to help us through the discussions today. And then please, throughout the session, you are welcome to also submit further questions on our chat line. We have a team behind the scenes that will collate those questions and sort of group them together in themes, and we're going to try and cover as many of those as we can. Finally, for those of you who are phase representatives, today's session will grant you some CPD points. We will circulate an email tomorrow with a link to the recording of this webinar, as well as your CPD certificate. Okay, I think let's kick off, Michael and Chris. Michael, I think if I'm going to start with you, if we just talk a little bit about the recent performance of the Prudential Balanced Fund. Clearly, these have been very challenging conditions in the market. Global economies have really struggled. The Prudential Balanced Fund, as we can see on this chart, has delivered over, and this is a 10-year time frame, some very strong real returns over this period. And also for most of the period performed in the top quartile of competitive funds. And as we can see, though, in the last sort of 12 to 18 months, there has been a pullback in performance on a relative and absolute sense, quite sharply into this COVID crisis. Michael, maybe let's kick off and just talk a bit to us about the reasons for this performance in this recent period.
So the question of performance really has two parts to the answer. Firstly, it's around the behavior of asset classes or the returns that were on offer to the fund in this period. This chart shows index total returns in Rand for different asset classes. And we showed for three different periods, 1 year, 3 years, and 5 years. And immediately what jumps out is the disappointing performance of South African growth assets, basically equity and property. So you can see over 1 year, significantly negative performances, and then for equity, basically you're not getting anything per annum over 3 and 5 years. So clearly the fund is exposed to these assets. We have a significant exposure given the sector we're in. We're in the high equity sector. We have an ambitious return target, and we can't get to that target without significant exposure to these types of assets. Bonds over the more recent period have also been disappointing, over 12 months. And the fund, given our valuation-based framework, had significant exposure to equity and bonds in South Africa. So that cost the fund going into the crisis. Contrast the return on South African assets with those of foreign assets, and one immediately sees that one got a much higher return from those foreign assets. Of course, the Rand had a big part to play in that. The Rand actually flatters the results of the foreign assets, because we're measuring returns in rands. And so in dollar terms, the assets still had reasonable returns, but not as great. So that's really the one part around the beta or the market returns. We also had some underperformance from security selection within the last 12 months. Maybe Chris can elaborate on that a little bit.
Thanks, Michael. As you highlight, the largest exposure in the portfolio, the SA equity, has delivered poor absolute returns over the 5 years. But what did certainly contribute to the bigger drawdown relative to the peer group was a period of poor stock picking, some of which we will discuss, but there were specific holdings within the portfolio that have detracted.
Thank you. Michael, we did get a question on also these absolute returns, of course, but also our peer relative performance to our leading competitors. The FSCA rules preclude us from naming those competitor funds, but can you just talk a little bit about how the fund has actually performed in relation to the sort of cohort of funds against which we would compare our performance?
Yes, Bernard, we've got a chart here that shows the dispersion of returns for our fund along with the 6 other largest funds in the sector. So we show the fund here, we show the minimum return, the maximum return is the top of the bar, and then it's divided into quartiles. We show the top 7 funds, including us, which is really around looking at funds that are similar size, and sorry, by top 7 I mean the 7 largest funds. We haven't chosen them because they're an easier comparator for us. On the contrary, these funds have generally outperformed the median fund over time. So what we're looking at here is the range of returns, the median return, and you can see that our median is at the median of our competitor funds or higher. The other feature that I'd like to point out is our dispersion, or the differences between the extremes, is in line with the other funds. So in general, our performance has been as good or better, and the risk has been very similar over this period. Now, the period I'm talking about, we're measuring 5-year returns over the last 10 years. Then the other point I want to make concerns the fund's recent performance. So the dot on this chart shows how the fund has done over the most recent 5-year period compared to those historical numbers. And you'll observe that across the board, with the exception of one of the funds, that most recent return is in the 4th quartile. So what does that say? Well, generally funds have struggled in the recent period against their own history.
Michael, thank you. That recent period, I think if we can just explore that a bit more. So this COVID crisis has been the worst sort of crisis that the Prudential Balanced Fund has seen in its 25-plus year history. As we can observe on this chart, the fund is down from peak by about 30% into the crisis. That's late March, versus, for example, the minus 16% contraction that we saw in the global financial crisis. Remarkably, it has subsequently returned 33%, so an extraordinarily strong and sharp recovery, a rebound in performance. It's not quite back to the levels that it started off from, but certainly has covered a lot of that, or recovered a lot of that ground. I mean, this implies some very interesting asset allocation positions in the fund, and potentially some changes that the portfolio has seen at an asset allocation level. So can we take a few minutes just to unpack how the team thinks about asset allocation and what were sort of the main changes made to the portfolio in this crisis period?
Yes. Well, as you say, very gratifying to observe the recovery, but still further to go. There are a few features here. So what we're showing is asset allocation now, which is the red bars, versus 6 months ago at the end of last year. So, obviously two parts of information you can take from this is how are we exposed currently, which will affect the fund's performance going forward, as well as what changes have we made. So the first point I'd want to make is that we're significantly exposed to equity, both local and foreign. This fund sits in the high equity sector. We're targeting ambitious returns, and so we would need exposure to those growth assets. What changes have we made? Well, we've reduced some of our foreign equity. The global recovery has been faster, certainly in the US and some developed markets, faster than in South Africa. So we've reduced some of the global equity and increased our exposure to South African nominal bonds, mostly in the longer dated area, where we've seen significant weakness during the crisis, and so we've bought into that weakness in line with our valuation-based approach. The other point to note is that we started off the year with a low exposure to property, and we've reduced that somewhat further over the 6 months as the risks to that sector become more and more apparent. We build those positions based on our assessment of valuations. This slide shows our framework for looking at asset class valuations. So what we're looking at here are real returns to different asset classes, both domestic and global. The dots show what we think these asset classes should deliver over time as compensation for taking on the risk of being exposed to those assets. I don't think it's controversial or surprising that it's upward sloping from left to right. As we take on more and more risk, there's more volatility, there's more uncertainty about cash flows, so one would expect to be compensated with a higher real return. The second part of this chart shows the current prospective returns or real yields. We based it on valuations, so we don't have a complicated econometric model. We have a very simple way of thinking about it. Really, the complexity comes into digging deeper into the asset classes subsequent to thinking about the overall valuation. And so here, I'll use the South African government bonds as an example. What we do is we look at the yield, in this case the yield to maturity. Now, we don't hold these assets to maturity, but it provides a useful steer as to valuation and expected returns over a shorter period than 10 years, possibly. So we look at the yield to maturity, we strip out expected inflation, and we end up with a real return or a real yield. So in this case, one would expect to earn somewhere around 4.5% real, which would be a better return than the grey dot, a higher number than the grey dot, and so one would say we would see that asset class as being cheap or attractive, and so we'd want to be overweight that asset class. So there are a few features. The one is that the South African assets generally offer better value than global assets. In particular, if we look at equity, you can see how the red bar for equity is above the dot, implying cheapness, whereas in global equity, it's slightly below fair. So we saw the recovery in global equity is much more rapid, as well as a reduction in expected earnings due to some impairment from the crisis. Another feature is if we look at South African bonds versus cash, we can see a significant pickup, and I'll speak some more about that later. So we've got a combination of different relative attractiveness. Cash, a few months ago, starting the year, was yielding significantly better. We've had interest rate cuts, and so now you're not even being compensated for inflation by when you hold those assets. Then, as a final point, I'd just like to mention, property on the face of it looks like this fantastic investment. Who wouldn't want 10% real from an asset class? Our concern really is that forward yield number, which is based on consensus forecasts, we think is risky. There's a lot of risk to that sector. given the environment we're finding ourselves in. So that's one where we're actually going against that signal and we're saying we'd rather own less property.
Okay. Michael, before we turn to equity and also introduce Chris into the discussion, just going back to the fixed income allocation, so that has risen from around 17 to 21%. Clearly the yields are there, but it is in sort of appears to be quite a risky trade considering the perilous state of the country's fiscal position. Can you talk a little bit more about that decision to increase SA government bonds?
Yes, certainly. We think about risk and return, of course. And so there's no arguing that these instruments are riskier than they were. The environment is riskier. The government finances are in a worse state. They potentially have much bigger problems given the decrease in revenue and increase in expenditure during this crisis. And of course, the government finances weren't in a great state going into the crisis, given the problems with slow growth and the SOEs, just to name two. Nevertheless, we have to think about what reward we're getting. And so when we think of bonds, we're thinking of the yield, as well as the potential for a re-rating, a capital gain. So in this chart, we're showing the yield to maturity of the 20-year government bond. And we're looking at what sort of compensation you can get, what you can earn on that, versus cash. So we're contrasting it with a cash yield, and these are annualized or annual rates. So at the beginning of the year, bonds, you could get 3%, about or slightly more than 3% more than cash per annum for owning bonds instead of cash, which we thought was pretty attractive. Of course, in the crisis, these yields have moved out. The bond yields, that is, they've increased rapidly. They have recovered slightly, but not much. And so currently you're getting over 7% per annum more if you buy bonds instead of cash. We think this is a legitimate signal, a very strong signal, and so we believe we're being compensated, in fact, overcompensated for the risks.
Thank you. Yeah, just before we turn into the equity section, just at an asset allocation level, equities make up, as one would expect, the largest portion of the balanced fund. It's about 2/3 of total assets, local and global. Can we just dig into that valuation a little bit more? The decision to be overweight equities, which into the crisis obviously hurt the fund's performance. How have the team thought about that and the decisions taken in the crisis itself?
Right. So with equity, there are a variety of valuation metrics that one can look at. We at the moment we are looking at price to book. We can see the history against of both global and South African equity. And a few years ago, we were trading in South Africa on a very similar price to book level to global equity. Subsequent to that, global equity has actually re-rated and South African equity has de-rated over time as the various fundamental problems within South Africa have manifested themselves. So we're at a point now with a current price to book value of 1.4 times in South Africa against our average, long run average of about 2.2 times, where we think there's a significant signal. We think there's very good value within that equity, South African equity, as an asset class. Now we leave it to Chris and his team to choose individual stocks and individual sectors within equity. We're looking at the total market, the total equity. So we're at a point now where if you look back over history, we're seldom this cheap. And why do we think that's important? Well, we can look at if you were to have bought equity at these kinds of levels, what was your subsequent return? So this chart shows a study that we've put together over a number of years looking at the price to book value of our market and then what happened over the next 5 years. What was your annualized 5-year total return after that? And we're not surprised. In fact, it goes hand in hand with our valuation-based approach to expect that this, broadly, the trend is downward sloping from left to right. So what that says is as the price to book gets higher and higher, so one can reasonably expect a lower and lower subsequent return. If we look at another feature of this chart, we've put a red line there. And that goes through the 1.4 point on the x-axis. So that shows where we are currently in terms of the valuation. The length of the line is also significant in that the line shows you what the least and the highest return that our market has delivered over the period in terms of 5-year annualized returns. So any point in history, you could think of it, if you say that there isn't really a reason why we're going to be completely different into the future, well, you can think of it as a range of expected returns. And then given that that covers the entire range, the point I want to make is, well, at this price to book, what's your range? And it's significantly improved. It doesn't go negative. It's from round about 16, 17% to about 45% that you could reasonably expect. Now, obviously, it's a huge range, but I think the key takeaway here is, given especially what we've been experiencing over the last 5 years, 16% per annum over 5 years is a great return.
Okay, thanks, Michael. Yeah, this is a good point to turn to Chris, perhaps, and talk a bit about the South African equities in the fund. As I said, it is the largest portion of the assets. So, Chris, this crisis has been quite extraordinary in terms of the extent of stock and sector level movements in share prices. Clearly, we were on the wrong side of some of those trades. For example, the overweight Sasol position that detracted from performance. But can you just talk a little bit about the movements that the team has seen and some of the decisions that you've taken within the equity section of the portfolio?
Yes, thanks, Bernard. Yeah, I think I should just take the opportunity to just acknowledge that the last 12 months has been a period of some poor stock picking, and as you allude, our position in Sasol has hurt performance, but it's not the only detractor. So before I talk about some of the position or current positioning and changes that have been made, just to give some context, what we're showing here is the price performance year to date of a variety of sectors and individual stocks. Sasol stands out as the black line at the bottom, in that despite a recovery from its March low, the stock is still more than 50% below where it started the year. This was a company to which we were overweight. In contrast, the gold sector, this is not the gold price, this represents the JSE listed gold sector. In gold, at the top of the chart, has returned almost 90% over this same period. This was a sector to which we were underweight, and we'll address that in a bit more detail a bit later. The other key takeaways from the chart are, below gold, we've shown both Prosus and Naspers. Admittedly, these two companies derive most of their value from their investment in Tencent, listed in Hong Kong. But they have very little to do, if anything, with South Africa and the South African economy. And so they have benefited from being, deriving value from a set of offshore earnings and benefiting from a weaker rand. And that holds true, but hasn't delivered quite the same performance. But British American Tobacco has still beaten the index, which is shown in the red line running through the middle of the series. British American Tobacco likewise doesn't generate much of its profit from South Africa. It is a more traditional defensive name, and so even though it pulled back in the March sell-off, it had a more shallow price decline. And then the last point to highlight is sort of the other domestic focused sectors, the banks, the general retailers, and food and drug retailers. The food and drug retailers in the pink color have were unaffected by lockdown and therefore continue to trade. And as a result, we've seen they have outperformed the general retailers, the apparel retailers that suffered an extended period in which they were unable to trade, as a result of lockdown. And similarly, the banks, which are almost solely dependent on the domestic economy from which they derive profits. If one now moves to how we're positioned, those of you should be quite familiar with this chart. We're showing in red the current sector positions of the equity slice of the balanced fund, how it is currently positioned versus where it was in June of last year. And so our approach is always to try and not take significant or sort of overlay a top-down sectoral view. We try to build a portfolio that is giving broad exposure across a range of sectors, and we pick stocks within sectors. So again, what I should highlight is in that non-mining, it's a combination of our position in Sasol and Sappi, a paper company that contributed to what was an overweight position a year ago that has shrunk to being more neutral. And unfortunately, in this case, this is not us having reduced exposure by way of having sold our exposure, but rather the price fall has meant that those stocks have underperformed, and in effect that has contributed to the negative alpha. On the far right-hand side, we just show the financials, and this is a situation where we've actually added to our exposure to the banks, given their relative price moves and the valuation signal that we will discuss a bit later. And then lastly, within the industrial sectors of the portfolio, just to draw attention to consumer services, in which there's a number of changes that have found their way into the portfolio. But we took advantage of the relative price moves between the food and drug retail and general retail by selling Pick n Pay out of the portfolio and buying a combination of Truworths and the Foschini Group. And again, it's our belief that we've just seen such dramatic relative price moves that we're prepared to act on some of the valuation signals despite all the negative noise and the relative performances.
We had a few questions from clients on the consumer services sector. Those businesses obviously facing off a consumer that's under significant strain. Can you just talk a little bit about potentially, some of the position changes or stock changes that have taken place there?
Yes, thanks, Bernard. One example, and this was covered in a previous webinar on the equity fund, but one of the single largest changes or additions in terms of a stock idea was a company called Bidcorp. This company, for us, exhibits a number of characteristics that would qualify it as a high-quality business. So just to explain the chart, what we're showing in the red stepped line is on the right-hand axis is a measure of profitability, or the EBITDA of Bidcorp. And then on the left-hand axis, we are showing both the debt and the market capitalization. So the market cap plus the debt making up the enterprise value of Bidcorp. What is noteworthy is the relatively low level of gearing or debt indebtedness of Bidcorp, making it, it has a very strong balance sheet, one that we think is well placed to withstand this crisis. And then the other observable noteworthy features is that red line has enjoyed a 15-year sort of history of having uninterrupted growth, compounding of profits, such that it makes, it's a high return business. This was a company that we were underweight prior to March, and so there's a rather precipitous fall that one can observe in the green shaded area of the market cap. I should note that we've scaled the chart such that the the EBITDA is on 12.5 times. So that's a multiple that we think is fair for Bidcorp. And when that green shaded area is above the red stepped line, it suggests that it's trading on a multiple higher than 12.5. But in the crisis in March, the drawdown meant that one was able to buy exposure to Bidcorp on a multiple of less than 10 times historic profits. What one can observe is that in the forecast, the last period, there has been a sort of a downgrading of expectations as a result of the virus. But we are pleased to observe that relative to our purchasing at around 200 Rand a share, we've seen an almost 40% recovery in the price of Bidcorp. And you know, it's this. What the key takeaway I'd like to leave you with is that in a crisis, one often gets the opportunity to buy great businesses at a good price.
Okay. Talking about great businesses and perhaps not so great businesses, Chris, the one position that has detracted in recent performance, but it's not one that the team has materially changed their view on, is the gold sector. And we've obviously had a few questions from clients on gold, I guess both the metal, the bullion and gold companies. So how does the team think through that sector of our economy and the stock market?
Okay, thanks, Bernard. Before talking to the gold sector, and as we've already shown, it's delivered some strong returns this year. Just to try and talk to the gold price itself, it's a very difficult asset to have any sort of sense of value or valuation anchor. What we're highlighting in this particular chart is the gold price in dollars in the red on the left-hand axis, and I've plotted it against the US real yields as measured by the 10-year tips. And just to note, that's on the right-hand axis, but it's been inverted. So as that black line is rising, what we're actually showing is that the yields are going more negative where they are today. So these are both safe haven assets. In times of crisis, investors gravitate towards owning gold as a perceived store of value, or your alternative is to buy the inflation-linked US bonds. But it's a rather confounding world in which we find ourselves today, in which investors are actually willing to pay the US government, and it's not unique to the US, we observe this in other developed markets, but are paying to, for the certainty of making a known, albeit small loss over the period of ownership of that bond. And during these periods where money effectively is costing you very little, owning a non-yielding metal like gold, we can observe this relationship. Lastly, the point at which we're at today is not dissimilar to where we were back at the previous peak in gold in 2012, 2013. And I don't have a crystal ball. I don't. It's not to say that gold can't go higher, but in order for that to materialize, it would appear that one would need bond yields to go more negative. Moving on to the gold sector, or the South African stocks into which we could potentially invest. This chart, again, the red line represents the dollar gold price on the right-hand axis. So the prevailing spot price today is around $1,800. And then on the left-hand axis, we've sort of got a graphical representation of the cash flow statement of the gold sectors. So it's an aggregate of all of the listed gold companies. On the in the orange, the gold color above the line is the profitability, the cash flow that they generate from operations, and we can see that there's a clear relationship. In periods of high gold price, gold companies make more profit. So similar to the previous peak in 2011 through to 2013, we saw elevated level of profitability, and that is projected to repeat in the coming financial year. But also in the grey bars, we can observe that in good times, South African gold companies need to spend more, so they invest capex in order to extend what are otherwise very short reserve life. The net is that what one receives as an investor, as represented by the black circles, the dividends that come back to you or return to you for investing in these gold companies is very limited. And so the dividends that are projected to be, or that one received in this past financial year, are below that we received almost 20 years ago. And so for us, it's the lack of free cash flow generation from the gold sector that leaves us choosing to put our money into alternative SA stocks that are, in our view, better cash generators, and hence we maintain an underweight position to the South African gold companies.
Chris, thanks. Let's just turn lastly to the financial sector, particularly the fund position in banks. It's a position we held, but we've also added to in the crisis. Just talk us through that a little bit. Certainly, sort of from the perspective of the extent to which bank share prices are discounting sufficiently the potential for rising bad debts.
Okay, thanks, Bernard. The largest bank exposure within the portfolio is Standard Bank, and we do acknowledge that there will be some challenges as a result of the lockdown and the pressure on the consumer. There'll be bad debts both from private individuals as well as corporates. But what we can observe here is a 30-year history of Standard Bank's dividend yields or dividends delivered. In black, we've placed that stream of dividends on a 3% yield, and in gold, I've used 6%. When we overlay the share price, I can explain, one can see that Standard Bank has traded within this range of dividend yield. So when the red line, the share price is touching that black line, it means that investors are willing to accept a 3% yield. And when it's on the gold line, they're demanding a 6% yield. But if one looks to the most recent data point on, the share has lost, at a point in May, Standard Bank had fallen over 50% from where it started the year. And as the heading says, in our view, this is more than just a suspension of dividends that may arise because of challenges or bad debts and the need to raise additional provisioning. The yield on offer from Standard Bank was over 8.5%, and one is being given this unique opportunity to buy exposure to Standard Bank cheaper than you've ever had in the last 30 years. So we don't disagree that there may be some short-term pressure on the dividend yield, but we believe that the valuation or the risk that we're willing to bear that risk of the dividends being suspended and potentially cut on the expectation that in a point in the future, Standard Bank's profitability can recover to a level that it was in 2019. What gives us that comfort is that all of the South African banks are far better provided in terms of capital adequacy currently versus where they were in the global financial crisis. So effectively, in answer to the question, it's the valuation that we think gives us odds, in our favour to accommodate the short-term noise and the headwinds to current dividends.
Thanks, Chris. I guess the topic of interest rate sensitive assets, maybe Michael, if I can bring you back into the debate. Let's just turn to the currency briefly. The exchange rate, obviously a very difficult asset to have a strong view on. But how does the team think about its exposure to non-rand assets? In the crisis, as you mentioned earlier, you did take some profit and brought some assets back into rands. And then perhaps sort of a second question, if I may, link to that. From our clients, a few have asked this: in a world without Regulation 28 limits and without exchange controls, what would be our preferred sort of normal offshore exposure in the balanced fund?
Thanks, Bernard. I'd like to reverse those questions, if I may. Answer the second one first. We think that an average or neutral or strategic position on the foreign assets should be somewhere around 25 to 35% of your fund. It's not an exact thing. I think you can think about it in a variety of ways. One way to think about it is we've got South African assets where you're earning what we think would be a higher return than in global assets, because you earn a risk premium as compensation for the risk of investing in a single country, namely South Africa, versus the diversification benefits that you can get from investing offshore, both through having a broader range of investments as well as through the currency, which is key. So you're weighing up the risk versus the return, and we end up somewhere in that sort of 25 to 35% range. There are a few other considerations. If we're saving in South Africa, you're saving to protect your South African rand purchasing power. So, we think it's difficult to say, you would need 100% offshore because that's maybe safest or something like that. But we think that's broadly the range where we would be on an average level. Of course, tactically, being active managers, we move around. So we would either overweight or underweight, take money offshore or repatriate it, which I guess brings me to the other question. So in the crisis, we saw well, I guess in the build-up to the crisis, we've seen the rand weaken quite a bit. So when we're thinking about South Africa, we always have to think about sort of broadly two aspects. The one is, we think about South Africa related fundamentals. We can think of, for example, the problem with Eskom's generating capability and its balance sheet. Can think of government finances, and then we also need to think about what are emerging markets doing, because emerging markets also, we are an emerging market and we move around with other emerging markets. So it's really a combination of factors caused the rand to weaken rapidly into April this year. Obviously, the COVID crisis has had a lot to do with the timing. And at 19 rand to the dollar, we saw an opportunity to reduce exposure to hard currencies, to dollars, and to increase exposure to the rand. So what we did was we sold some foreign assets. Bear in mind that in April, the recovery in certain developed stock markets was well underway. And so we were reducing exposure to assets that were not at their lows. And we bought South African government bonds. So that was an opportunity to both reverse the currency trade, to bring money back from dollars, and to invest in a high-yielding asset that we thought had significant potential.
So, Michael, once the decision to externalize money has been taken, in those offshore markets, where at the moment are you seeing opportunities? How's the fund being deployed in terms of the offshore component? As our audience will have seen from the slide a while back on asset allocation, we still have significant exposure to global equity. Within the global equity, we have an underweight position to United States, to the S&P 500, to American stock markets, and that's really around the fact that market has recovered the fastest. The valuation gap between it and basically the rest of the world has opened up. So even prior to the crisis, we were underweight the US, given that its valuation looked expensive on a relative basis to the rest of the world. So within the rest of the world, we seek to gain exposure to the better value markets, which are really a combination of developed and emerging markets.
within the fixed income part of the portfolio, the major change there is we've introduced exposure to the 30-year US Treasury bond, and that's really a diversification or insurance asset. So it has a very low correlation with US stock markets, and so if we were to have a hiccup or a disappointment, we've seen a very quick recovery in stock markets, so potentially there's risk of a hiccup. This asset tends to move in the opposite direction. So we're getting some yield. It's about 1.25%, 1.3%, something like that. But that's not really the reason for owning it. It's about its diversification benefit should the recovery falter.
Right. Thank you, Chris and Michael, for your time. Before we move to sort of live questions that have come in through the session, I guess clients have asked us what to expect going forward. The conditions currently are, of course, very trying. But as an investor in the Prudential Balanced Fund, what should our expectations be for this fund over the sort of medium term from here?
Okay, Bernard, if I can just kick off with, I'd like to leave the audience with 3 key points that hopefully we've addressed in the course of the presentation. But, often we hear this statement that the future's uncertain. I would just like to remind everyone that it's always uncertain and that there are always going to be unknowns. I don't know when earnings for the companies discussed today, revert back to levels seen last year. But on the second point, what I hope we've demonstrated is that, the SA market valuations today, in our opinion, are discounting a lot of bad news, and that it's that willingness to back the valuation signal and the odds of these more attractive returns on a prospective basis. And then just lastly, and I think it was illustrated in the discussion around Bidcorp, crises in our view, and it applies to other asset classes too, but they present opportunities, and it's this opportunity to buy good companies at great prices that gives us confidence on our ability to deliver better returns to the investors over the next 5 years.
Thanks. And to add to what Chris said, I've got a couple of points. Really, firstly, I'd like to say, these crises such as what we've just been through, and, it's not over yet, but certainly the asset price, we have hit a trough and a recovery. These crises test us, and, I think we followed our process through the crisis. We were all the way down as asset prices were falling. We were evaluating prospects and making decisions about increasing or decreasing exposure. We made certain decisions. I think that's reflected in the recovery in the slide you showed towards the beginning of this webinar. So, we followed our process. We've invested in those assets where we thought the risk would be rewarded, and reduced exposure to those assets where we thought we were not getting rewarded for the risk, or the risks had gone up. And then really my final point is around prospects for the fund. I think we've certainly shown in our view that there are attractively valued assets that we can buy at an asset class level, as well as within the stock market that Chris spoke about. We think we've positioned the fund correctly given our assessment of those opportunities. People always want to hear a number. What sort of return can we expect? Of course, it comes with a huge health warning that the fund is volatile. It's invested in volatile assets, so it can be a bumpy ride. But over time, with a reasonable time frame, one could expect sort of low double-digit returns to the fund, sort of 10 to 14 range, something like that per annum, which would translate, depending on what happens with inflation, to 6 or 7% or even higher real return for the fund. So definitely one would expect a lot better than the recent period and a reasonable return.
Great, thank you. So as you say on the slide, time to be cautious but not timid. So that brings us to the end of the pre-submitted questions. As we spoke, a few further questions came through on the chat line. So we're going to take a few minutes to see how many of those we can respond to. They have been broadly collated into sort of themes, so we'll paraphrase some of the specific questions. And let's take the last few minutes of the session and just see how many we can get through. Yeah, so the first question on the live chat line that we received from Andre concerns prescribed assets and what Prudential's views on this is. I'm happy to actually take this one. So firstly, I should say that as a firm across our client portfolios, we do invest significant amounts into mainly SA government bonds, some 38 billion rands of exposure that we hold, and about 8 billion rand into municipal and state-owned enterprise companies. And those, of course, all have a form of developmental objective. So it's not for us a question of not being willing to deploy savings, the savings pool into these opportunities, but there's much more concern around the absence, I guess, of well-executed bankable investment opportunities that we need. We would be opposed to prescribed assets for obvious reasons. It's been tried before. It tends to distort price discovery in markets. It imposes limitations on the flexibility of investors and pension funds. And of course, also, since it was previously done to today, the savings market has moved. We now have much more defined contribution funds where individual members move between funds and require daily liquidity in their portfolios. And the typical type of prescribed investment opportunity is not valued daily and that does not provide sort of daily value liquidity opportunities. So we are, as a firm, across a number of our colleagues working through the CISA bodies that are engaging with government to find mechanisms through which we can structure, as I mentioned, more effective bankable investment opportunities that can be developmental in nature. So thank you for that question to Andre. Then a second question from Clem, and this concerns the graph that Michael showed on the valuation across asset classes, and specifically the observed consensus yield on property being quite high relative to its sort of fair value anchor, versus our relatively low exposure in the fund of around 2% to the property market. So Michael, there were some questions around just marrying that, what seems to be a very cheap asset versus an underweight allocation. And I guess by its nature also the concerns around the property sector. So can we maybe just repeat some of those points and touch on that in a bit more detail? And Chris, at a stock level perhaps.
Sure, Bernard. So it's correct. The forward distribution yield, which is based on a forward distribution number 1 year out, which is an assumption or a forecast from the consensus from a group of analysts. It's a ratio, so it's that forward distribution divided by price. And so what we observed is that in fact, this is something that's been going on the last couple of years, but certainly with the crisis as well, as price fell, earnings or future earnings were being downgraded, but price was falling faster. And so what you got was that yield or future return going up. So our concern really is around the fact that those consensus earnings have not been falling fast enough. In comparable global investments, we've observed a much quicker reduction in those forecasts. So it's on the face of it at total sector level. On those numbers, it looks attractive, but we're concerned about those risks to those future earnings. Within our portfolio, we've got different stocks, and Chris can talk a bit more about that.
Yeah, thanks, Michael. So from a stock picking perspective within the property, our property team have chosen to favor offshore rather than SA focused REITs. This, it is in part because so the largest overweight is Resilient, as well as Nepi Rockcastle. NEPI is predominantly Eastern European focused in Poland, Romania. One of the reasons our property team likes these two names is that they are less leveraged than some of the South African counterparts, but we are also seeing a faster recovery or return to normality post the crisis. And so NEPI's shopping malls are reporting that come the end of this month, they're seeing footfall that's almost back to 95% of the level pre-crisis. In addition, a couple of other examples are to look outside of sort of traditional office and retail exposure, and we have holdings in equities, property fund, as well as storage. So these are property companies that have exposure to logistics, warehouses, as well as self-storage units, and therefore, we favored those where we believe there's underlying organic growth that gives us comfort that the distributions that Michael refers to can arrive and won't be permanently impaired. Thanks.
Thank you. Then a question from Giovanni. This is an issue that has actually received a bit of airtime in the press in the last few weeks again. A number of South African companies have tried to diversify their businesses into global markets, very often with, let's call it, less than successful outcomes for investors. What is the equity team's view on management teams of these companies and how they externalize capital?
Thanks, Bernard. Thanks for the question. It is indeed the case that there's a host of examples of companies, South African companies, that believe, for a variety of reasons, that have taken the decision to make acquisitions offshore, and there are more disappointments than there are successes. One of the key motivations has often been that this is a market, South African economy, that is offering low growth, or perhaps their domestic business is mature and enjoys a dominant market share, and hence they go and seek growth offshore. We remain quite skeptical about this acquisitive growth strategy, and also skeptical about what value add can these management teams bring to other mature markets in the likes of the UK or Australia. And so for us, there is an analysis of the capital allocation, and what we have seen in history is that often these deals are done at exactly the wrong point in the cycle. It's either at the point when the rand is really weak, and therefore you're seeking to diversify your earnings base, or it's a case of just overpaying for a prospect of growth that doesn't actually materialize.
Thank you. I think we're sort of getting to the end of the session. There's time for one more question, and this is perhaps one that the two of you can share. So a few clients have asked that it would appear that our portfolio is positioned with a relatively bullish view, I guess, on the prospects for the South African economic recovery against the face of very challenging conditions outside. How do we reconcile the positioning, I guess, both at an asset allocation perspective as well as perhaps into SA equities versus these economic headwinds that we're facing? I don't know, maybe Michael can kick off.
Sure. So, we've observed slow economic growth over a number of years. And of course, more recently, we're in this self-induced slowdown or decline in economic activity as we've locked down to try and counteract the health effect or the negative health effect of the COVID virus. So, undoubtedly, we all know this has had a profound impact on life and businesses in South Africa. So, when will we recover and how much will we recover and all of that? We don't know. I don't think anyone can say with any degree of certainty how this plays out going forward. We can observe in other countries that are further advanced through this crisis than we are, where there is a resumption of economic activity, and one can see that definitely activity is well off the trough during the crisis. What we can observe is the valuations and the price behavior of different assets. And earlier on, I showed the price to book graph of both global and South African equity, and we can observe our current valuation. So, you know, we do think there will be some recovery, you know, going in at some rate. And as that occurs, we do see a re-rating. Some of it's happened, but we see the opportunity for businesses to recover. And so it's about your starting valuation and what you will earn subsequently in terms of a return. Maybe Chris can expand a bit.
Yeah, thanks, Michael. Yeah, so without wanting to sort of repeat the example of Standard Bank, but it talks very much to some of the points that Michael has already made, is what we're observing is valuations for a number of South African facing companies that are, you know, the lowest. You're getting an opportunity to buy them on multiples that we haven't seen in 40 years. And we acknowledge that there are going to be consequences of a self-imposed lockdown. It may well lead to rising job losses, etc. But it's not that we haven't experienced crises in the past. But yeah, so it's an unknown as to when Standard Bank's earnings or dividends return to the level that they generated last year, but that the quantum of the price fall in our view, you know, at a point in time, Standard Bank had fallen more than 50% or lost 50% of its value this year. If you simply lose 1 year's worth of dividend and then dividends resume and get back to last year's level, you know, all you've really foregone is a year's worth of yield. And so it's the magnitude of the price fall, and we believe that those share prices are discounting a lot more bad news than what the future holds. And that's, we're prepared to back the valuation. As I said earlier in the presentation, we don't know, the future is uncertain, and we don't know the path of the recovery.
Thank you, Chris. Thank you. I think that brings us to the end of this webinar. Thank you ladies and gentlemen, for joining us. We hope you found it of interest and of value. As I said at the start, we will email out tomorrow a link to the recording. So if anybody wanted to look at some aspects of this again, feel free to do so. And on the website, you'll also find recordings of the previous webinars in this series. So on that point, my thanks to Chris and to Michael, colleagues, for your time and your assistance in preparing. And have a good day and stay safe. Thank you.
Thanks, everyone.
Thank you.